Good morning. I'd like to talk to you a little bit this morning about the Great Recession and the Dodd-Frank Act. So the Great Recession uh, develops over several years. The factors that really contributed to it began developing in the 1990s and into the early 2000s. The bubble breaks on finance somewhere around 2008. 2009. During this period of time, we have the collapse of Lehman Brothers Bank, which was at least 100-year-old investment bank that caused tremendous ripples throughout the financial industry, ultimately resulting in banks barely trusting each other and working with each other, which we could think of banks as being sort of the oxygen or the lubricant to the financial system. So if banks fail to talk to each other and work with each other, you really have a financial crisis, and that's what we had in 2008 through 2009, gradually turning around. And in fact, we're still gradually turning around because we've not yet seen good wage increases, although we have a high level of employment currently. I want to get to some slides. So what brought about the Great Recession? Well, as in many financial crises, debt brings about the Great Recession. We had what's labeled here as unwarranted extension of credit. What does that mean? Well, it means that borrowing was allowed from those who really were not well profiled to service their debt. If you have a relaxation in underwriting standards, that means that those at banks and mortgage companies have relaxed their standards for lending, and they're allowing more borrowing than really ought to be occurring with those who have less and less of an ability to service the debt. So we have a huge amount of unwarranted extension of credit. This is brought about primarily because the housing industry had gone through a long, protracted series of increases in real estate prices. Mortgage lenders and banks reasoned that if housing were to forever go up in value, then those that borrowed and took out significant mortgages would forever see their equity in the home build as the value of the real estate continued to increase. Unseen by the market was the fact that real estate was in need of correction, and this ever-marching increase in real estate prices going forwards turned around, causing those to have borrowed to now not be able to build equity in their homes, or perhaps equity in their homes was used on a home equity line borrowing basis to withdraw equity from a home at a point in time when you had a significant mortgage, creating even a greater responsibility to repay the bank during a period of time where a primary asset, your home, is declining in value. So a lot of what went on preceding the financial crisis was this ever-increasing value in real estate, relaxed borrowing standards, and an ever-increasing amount of debt on behalf of homeowners, and an extension of risk on the part of banks. All of this turns around when real estate reaches its peak in value, which might have been 2007, 2006, and then begins to decline, creating a crisis in the inability of people to repay their mortgages. At the same time, we had some complicated products called credit default swaps that got banks into difficulty even beyond their loan receivable crises, aggravating the weak financial condition. So in response to this, we have the Dodd-Frank Act. The Dodd-Frank Act is to provide us with some protection for consumers, and also to give additional accountability and transparency to the system, and to put in place a situation where the government would not need to bail out industries like the auto industry, investment banks, and other insurance agencies, large organizations that had to be bailed out as a result of the Great Recession. So Dodd-Frank Act puts in place what's called an orderly bankruptcy and liquidation process for non-financial companies, consolidates those that regulate the financial industry. By that, I mean banks, insurance companies, investment banks. Puts in guidance over hedge funds, requiring them to register with the Securities and Exchange Commission. Establishes something called the Volcker Rule, which means that banks can no longer take on speculative investments with the deposits that are in place at the bank. And we finally have the Consumer Financial Protection Agency put in place. This was a great accomplishment of Senator Warren of Massachusetts. Since the Trump administration has been in place, they've taken action to try to limit some of the consumer protections that were passed. So this is sort of still under development. But the point with the Great Recession is that we had this large extension of credit to those that are not necessarily well positioned to take on additional credit. And the banks found themselves in an ever weakening position. Banks are required to keep reserves. If the bank takes in $100 of deposit, normally the bank will turn around and lend out $96 of the $100 they took in deposits. That means if everyone scrambles to want to withdraw their funds from the bank at the same time because the bank is weakening, then there are not adequate reserves. So reserve levels have now been increased. Banks are subject to stress tests. Those who want to borrow money have to meet much more stringent guidelines on borrowing, be in a better position to repay their debt. And we are still recovering from this Great Recession. So we'll talk about this in a little further detail in one of our class sessions, but that would give you a beginning understanding of the Great Recession and the Dodd-Frank Act, which occurred in response to it.